Hello and welcome back. Cuzin's here, training educational session powered by Liteforex broker. Today we have a special one for you guys. You really don't want to miss out on this one. I'm going to take up on a difficult subject, complicated subject. Nevertheless, one of the most two important elements when it comes to trading the markets. Now, what I'm referring to is money management, also referred to as risk management, right? Everything between the moment you establish a position, you open a trade, and all the way to its termination. What are you doing in that period of time? That is crucial. In fact, the way I see it, there are two pillars, fundamental pillars, that if we're not dominating these two pillars, it's going to be very hard to become a successful trader, a consistent, successful trader. The first element I'm talking about is the predictive system you're using, right? When I say predictive system, I'm talking about, your main strategy, your main methodology, the system that helps you determine and finding opportunities and acting up on these opportunities, right? The second pillar, right, fundamental pillar, is the money management. It's what you're doing during the time when you hold a position. This is a very tough subject, like I said, so it's not going to be easy, but bear with me. But I'm going to share with you my views when it comes to money management. I'm going to show you the way I do it, how I manage my position, all through its time span. So it's going to be super interesting. I'm gonna talk about 3 case studies. I'm going to demonstrate 3 case studies, but in real time. This is real life case studies. 3 positions, active positions that I'm in right now. Now I'm going to take 3 different positions. One which is very old, more than 40 days. So it's kind of in its end cycle. It's kind of dying, right? And I'm gonna explain about that. But it's kind of at its end with regards to its lifespan. A second which is kind of in the middle of its lifespan, and a third position which just started, just initiated a couple of hours ago today. So you're gonna see the way I manage my position from 3 different angles. I hope I'm going to be able to simplify this as best as I can. Alright, are you ready? Let's dive in. Alright guys, so think about it this way. When it comes to money management, there is really a huge amount of tactics, different techniques that people use. But I think it's mostly, if you boil it down to basic principles, you'll find a handful of basic principles that govern money management. Obviously, the simplest one, that's the one that I've started with. I think most, beginners start with the very simplest form of money management, which is set it and forget it, right? You open a position. You have your stop loss level, you have your take profit order, you have your price target, and that's it. You open the position, you set it, and you forget it, right? You come back later on, you check it out. Maybe it reached the stop loss level or the price target, and if it did, that's that. Position is out, and you're ready for the next one. Now, there's a big problem with that type of money management, obviously. It's very inefficient. It's very inefficient because it basically ignores all of the corrections along the way, all of the counter moves, and it doesn't take any advantage of momentum or turning back to the original trend. It's just a simple form, and usually it's also very hard from a psychological point of view. And normally, I have to say, most traders end up with not reaching their price target because, it takes time to reach. Usually it takes time to reach, for price to reach your target. So in the middle of the way, it's going to go up and down. It's going to stall for a while. It's going to correct. And from a psychological point of view, usually traders, especially unexperienced and beginners, tend to get out before the price target is getting hit, right? Because they feel that, you know, they suffered enough along the way. Price was up and down, and at some point where there is some profit, they take it out. And obviously they miss out on the rest of the move when it actually starts to materialize. But they always hold positions to their stop loss level. So almost never making it to the price target, but always holding position to the stop loss level. And that's a problem. That's a big problem. Now the reason is it's very simple to explain this from a psychological point of view. Obviously hope gets the better of you, right? Hope is it's a problematic characteristic, should I say, when it comes to trading. And hope gives you basically it stops you from doing the right thing, which is cut your loss short. This is the most important cliche in trading, but it really is the fundamental concept that you have to follow all the time. Cut your losses short and let your profit run, right? It's easier said than done, I have to admit. This is why the simplest form of set it and forget it is problematic. In fact, what you get at the end of the day, if you think about it, is let's just pretend that you have X X amount of pips to your stop loss level, and you have the same X amount of pips to your price target. Just an example. Basically what happens is you end up with earning probably 0.5, like half of pips, half X when you actually you pull out of your position, right, prematurely. You never wait till the price target, but you always end up with 100% loss. Well, because you always wait to the stop loss level to be hit, right? That's just a typical behavior of beginners. I was right there for a couple of years actually. Now let's talk a little bit about another form of money management, which is the most popular form of money management, but is also it is also the wrong way to go, I have to say it. Most traders tend to use kind of an advanced money management, but it is actually worse than this one, the simplest one. They would better be off with doing this simple set it and forget it money management than what I'm about to describe, and you may be familiar with what I'm about to describe actually. So what I'm about to describe is the most famous money management technique there is, doubling down, right? Doubling down, that's actually, it's an intuitive kind of behavior. It's a reflex. That's what you want to do, right? Because you entered at, some point, and if price, let's say you entered here, right? And price goes against you. So you tell yourself, well, I bought at 97.20. Now that price is at 96.20, it just makes sense to buy more, right? Because I believe in my conviction. And that's the problem, because you might be wrong on your conviction. You have to take that under consideration. You might be wrong on your whole conviction. So what most traders do, and what I used to do myself at the beginning, was doubling down. So price went against me, I bought more. It went against me more, I bought more, right? Sometimes I would actually play with exponential type of doubling down, what we call the Martingale, right? When you buy double what you bought the first time, and then you buy 4 times what you bought the first time. So you're doubling down, but in an exponential fashion. That always leads to disaster, guys. There is no way around it. Doubling down is the worst form of money management. There, I said it, right? In fact, what I do is the exact opposite of doubling down. What I do is what you call scaling. Scaling, and I do the linear scaling. Linear scaling is all about buying high and then buying even higher, and then keep buying even higher until you reach your target. So basically, if you think about it, any standard, any typical trader, what it would do, it would buy at some point, and if it goes well, he may take some profit out, right? He would decrease the position, and if it continues to go well, he would want to lock in more profit, so he would close more of the position. That's the intuitive way to go, right? As price goes with you, you decrease the position. But when it goes against you, you increase the position. That's doubling down. I do the opposite. Instead of taking profit when it goes my way, I actually increase the position. This is counterintuitive, guys. It's hard to do. Because you're buying in a worse price than what you bought last time. You have to get used to it. Because your intuition behavior wants to take profit, because there is. But instead of taking profit, you leave it there and you increase the position even more. You add up another portion to the position. And I do the same on the way down when things go wrong. When things go against me, I decrease the position. Instead of doubling down and increase the position, I actually decrease the position, which means that I'm taking small losses. And that's tough from a psychological point of view, right? It's uncomfortable to take small losses, but you have to look at the bigger picture. So I'm doing scaling, the scaling technique, which means you scale in when price goes with you, and you scale out, you scale down when price goes against you, right? So it's the opposite to what most traders do, right? You have to get you have to get your head around this one. But I do a linear scaling, which means I put the same trade, the same size of trade every single time, right? I don't play around with the size. But here's what I do. I'm always starting small, right? Because using this type of technique, where I always increase my position, allows me to start very, very small. And this is very important, because I noticed that, I have about 15, 16 years of experience trading the markets. Only the last 6, 7 years I've been able to really, trade the markets for a living, basically, and become consistently successful, so to speak. And a lot of it has to do with the fact that I completely changed my money management tactics, right? And this is exactly what I'm describing. I basically reversed the process, right? Starting using this scaling technique. So think about it. For example, my predictive system pointed out for a strong opportunity, right? And let's say I got in. So when I want to establish a position, I always start 10% of my normal position size. So for example, this account, my normal position size would be $100,000, one lot, right? So instead of starting with one lot the way I used to do before, many years ago, now I start with a fraction of it, 10%. So instead of one lot, $100,000 position, I would start with $10,000 position. And then for every positive day, for every day that goes with my in my favor, I would add one more portion, which means one more 10%, right? So I'm doing even portions. This is why it's linear. This is why it's linear scaling. So every positive day, every day that has contributed to the continuation of the trend, I will add one portion. Up until a point, and at some point, usually I get to 5. Basically, I count 5 additions. When I count 5 additions, from the 5th addition, I would start to decrease the position if price goes against me. Now, look, I'm going to describe a simple form of this scaling system that I use. I actually do a more complicated way of doing that. I actually do this a little more sophisticated. I'm using my C-matrix key levels also to help me determine whether I should add or subtract. But I keep the principle very simple. As price goes with me, I add portions. As it goes against me, I subtract portions. Let me give you an example. I just told you that I have, I'm going to show you some case studies. And I'm going to start with the oldest position that I have here. This is the Australian versus the Canadian. I'm holding this one, I think, for a really long time, I mean, probably for 50 days now. Let me show you exactly where I got in. I got in right here, right, and on this bar. Take a look. Before the explosion out, right? This is where I got in. The price was 92.92, and I started with the first portion, as I always do. Now I jumped the gun here. I didn't even wait for the breakout. I was looking at a trading range right here, and this was my main point of reference. So basically I was supposed to wait for a breakout for this moment right here when it broke and closed above that level. But I decided to jump the gun because I noticed that price on the way down the day before, it failed to break below the mid-high key level here, 92.94. It left a spike here, so I was convinced that we're going to see a breakout. And it also fit the bigger picture. The bigger picture, let me quickly show you the bigger picture. This is the monthly chart. So price came from below, right? Another trading range, by the way. This is my main predictive system. This is how I, make decisions, right? Make trading decisions. So price took the previous 2 lows. Take a look. Took the previous 2 lows, was right in the lower section of my setup here, and was beginning to turn around. So from the bigger perspective, it was a classic opportunity on the way up, with the intention to reach the higher section, the level of 10070. Now that's an ambitious move, right? I was aiming for a 800 pip, basically 800 or 700 pip. And it went really, really well. I've done so well here. I'm very, very pleased with this position. I'm a bit disappointed that it's dying right now, but I have made a fortune on it already, so it's already done. What's dying right now is the last portion that it's still in, because I still believe in the conviction. But if it's going to continue to go against me as it is right now, I mean, it does that for the past probably 10-12 days, then I will pull out completely. But the most of the profit was already made here, guys. Even though I've already reached, I only reached halfway through, right? Think about from 93 roughly. At the peak I was at 97, 400 pip, sorry, almost 98, almost 500 pip at the peak. Most of my position was out around 400 pip profit and 450 pip profit. But, it was halfway through, right? I still have a big, huge distance to my final destination. But this is where my very unique money management tactic kicks in. This is why it is so efficient, so effective. And when I say effective and efficient, I mean by that, before I'm going to explain about that, let me explain one more thing. This is the beauty of this tactic. Because if you remember the first example, let's say we have X pip to our stop loss level and we have X pip to the price target. This particular linear scaling technique will end up in a situation where if price goes against you right from the get-go and it goes straight to the stop loss level, you basically end up losing, instead of 1x, you end up losing 0.3x, right? 0.2, 0.4, a fraction of that X, because you scale out. And vice versa. If you think about an X pip to your price target, because you're scaling in constantly and scaling out when it corrects, you end up with having, when it reaches the price target, you end up with having 2X and sometimes even 3X. So you understand, so you see my point, right? This is the fundamental concept of cutting your loss short and letting your profit run. This is how you manifest that principle in real time. Simple. But let me show you an example, right? I was talking about showing you this particular case study, which I still have a position in. And I have just the last, the last portion, 10% of the position. And here how everything started. Now I started right here. This is where I entered the trade. I'm going to put these black dotted lines, right, to mark my my additions, my additions to this position. Every time I added one more portion, I'm going to show you exactly how I did it and according to what principle. So this is where I started, right? And there was a big move, obviously, very strong move. It was easy for me to go ahead and add one more portion right there. And I'm showing you exactly where the close is, because I always wait for the close. At the end of the day, at the beginning, I look at the previous day. I look at the close. I analyze for a couple of few seconds, and I make a decision whether I need to add one more portion or not, or maybe I should subtract the position. Anyway, you see what I mean. Later on, I have to say that the next day was having a reaction. You can see the reaction, right? You can see the spike here. And that was a bit concerning to me. Usually when I see such a behavior where price is kind of spiking an important key level, such as this one, the 94.47 here, I usually at that point, it's visible. You can see how the market was trying to push through the Aussie Canadian here, but it failed. So that was a bit concerning. Usually when that happens and I have a big position in place, I cut half of it. I could cut 30%, 40%, 50% sometimes of the position. And only if it continues to break through, I will re-increase the position again. Like I always do, slowly and gradually, day by day. So, but here I didn't take anything out because the position was very small and I was just beginning, right? It was very close to the price entry. So it was only 20%. I didn't touch anything, but I also didn't add to the position. I didn't add the third portion. By the way, I only add another portion when it's visibly closing above the previous day. I don't want to put another portion if it only went a little bit above the day before. I want to see it visibly advancing towards my destination. That's the most basic principle here, right? Now the next day, the following day, the one that actually closed slightly above the 94.47 was very promising. By the way, whenever I see this type of behavior where price is closing the day above an important key level, that actually helped me easily to add one more portion. So I did. I added the third portion somewhere right here. Let me close in a little bit. Okay. Yeah, much better. So the following day, obviously another positive day. I've added the fourth portion, right? And then the fifth. Take a look right there. Then I didn't add up one more here because you can see how close it was to the previous day, right? It was a positive day, but it's very, very, very small. So I decided not to address this one because I want to see visible advance. This was not the case. Later came a negative day, right? Now, for any negative day, I will begin to subtract my position. So when I saw the first negative day, I took out this first portion. You see where? 220 pip profit. The first portion, right? That was out. Oh, sorry. I didn't mean to take this one out, of course. So the first one out, right? Now think about it. Whenever I subtract now the position, whenever I subtract trades, portions, basically what I do is take profit. That's what I do, right? Because I'm taking out earlier, older portions that I added. So the first one was out. Then we had the second day on the downside, right? The second portion, also in profit, was out. Then we had a bullish move, right? A bullish day, and it was very inspirational. It completely crashed that downside correction, so I decided to add up another portion. So I'm back in scaling in again. And then another one, another positive day, decisively above the previous day, another portion, and yet another one. So right now it's 1, 2, 3, 4, 5, 6, and I added one right here. So I was at 7 at that point. 70% of my position size was in at this point. And then came this move. Take a look. We had the first negative day. I took out the oldest portion here, right? And another negative day, I took out another portion, the oldest one. Then came a positive day. I did nothing, right? Didn't subtract, didn't add, because it wasn't closing above my, By the way, for me to come back to re-increase the position, I need price to set a new record. It's not just being positive. It has to be positive and above, closing above the highest portion I had. It has to advance for me to come back and increase the position. This is the smart part of it here. This is the sophistication. Think about it. So I did nothing, right? And then another negative day, guess what? I took the oldest portion. By the way, all of which were in profit so far, right? What we had then? We had a positive day. I did nothing because it was down, right? Still very much below the highest, the highest portion I added, which was probably 5 days before. Then another positive day did nothing. Another positive day did nothing, and then a huge day positive that set a visible and decisive advance from the highest portion. So I added up another one. Let's see where we're at right now. We have 1, 2, 3, 4, 5, 50% position size at this point. And then another one right there, 60%. Then some problems began, right? Some problems began. Price began a pretty significant correction phase. Now, it's not too, it's not very aggressive on the downside. It's actually more even a sideways correction. Nevertheless, it was a correction, and we started to see some negative days. So the first negative day, right? I took out the oldest portion in a nice profit, and then came another negative day, and I took out the oldest portion again in a nice profit. Then we had the positive day. I didn't add a portion here because it was very close, right? Too close to the last time, to the highest last time I added. So it wasn't decisive enough. I didn't add one more portion. And then came a negative day, and I took out, well, the last one, right? The first one, sorry. Well, the oldest one, sorry. Then another negative day, and another one was out. And then positive day, I did nothing. Positive day, I did nothing, right? Because it's well below the highest part. This is the watermark technique we're using here. Then another negative day. This is the first time I'm taking a loss, right? And it's a small one because here it is. Here's the level, right? I closed it right here. It was a small one. And later on, well, I ended up with just one portion, which is this one. And I don't even have to mark it because you can actually see it. It's right here. Now, when I left with one portion, I don't close it. I leave it to either take out by the stop loss level, which by the way I adjust. It wasn't at 95, obviously, right? It was somewhere at 90. So I adjust the stop loss level, but I give it a lot of room. Really a lot of room, because this system allows, this system is basically, if you think about it, it's like a built-in stop loss management. Because when price goes against you, you subtract, right? You reduce the risk inherently. So this is also kind of second-degree stop loss level mechanism, if you will, which is why I can put my stop loss level really far. I want to give price room for downside corrections as well, because when you add up and you subtract, you basically start to surf the waves, right? Whenever you have the correction, you begin to subtract, but basically what you do, you take profit from older portions and you wait out for the correction to end, and you go back to increase the position again, and then another correction and you subtract again. Once again you take profit from the recent positions, trades you added, and so forth, right? I think you get the picture. But when I have that last portion, I keep it. Doesn't matter now what happens. Negative day, positive day, doesn't matter, until I have a positive day that, you know, surpassing the previous high, then I'm not going to add anything. And I can't subtract anything, because if I'm going to subtract this one, it means I'm going to close the position, but I still believe in the conviction. Now, there are cases when I will take out that last portion and close the position altogether, if I feel that the technical situation have changed and it's more likely to go, you know, to completely turn direction, to capitulate, right? If I feel that the technical situation have changed significantly, I may choose to get out with that last portion, which is in a loss right now, but it's just one portion. So it's really not, you know, in light of the bigger picture, the whole position that I've been able to capitalize on here, it's just a tiny little loss. So yeah, this is how I do it, right? And you can actually see that it's getting closer to my stop loss level. Not sure I'm going to wait all the way there. I think that if price will break below this key level, 95.71, I'll probably pull out from this last portion that I have, close the position, and go look for opportunities somewhere else. That's the case. Now let me show you, this is why I told you at the beginning that this is a dying position. Now you understand what I meant, right? A dying cycle. Now the correction is too big at this point. Not necessarily in terms of price, more in terms of time, right? It's too significant, and it's probably best to be out anyway. And we can come back later, right? Which is something that I usually do anyway. But at this point, this is the end of this cycle, of the lifespan of this position. This is why I said I'm going to show you the old position, the dying position, but then I'm going to take you to kind of a middle position, in the middle of its lifespan, getting closer to its end actually. This is a real life position, Canadian versus Japanese yen. I hold a bearish position here, according to you know, we got some serious negative sentiment in the stock market, in Wall Street, in the equity market, and that has a big effect on the yen, right? All the yen pairs. So I took a short position on the Canadian versus Japanese yen, and you can actually see my portions here. Take a look. So I'm holding 50% position size right now, but wasn't like this at the beginning, and you know what? I didn't even begin here. Because if you look at it, you may think that I started right here, right? With the first portion, second, third, fourth, fifth. But no, this is actually the second round. You know how we scale in, scale out, scale in again? I actually started here. Right here, take a look. This was the moment of entry. Basically what I saw here was an exhaustion gap. I think we just had a couple of sessions ago a full session on exhaustion gap, and I think I was showing you this particular example in that session. If you haven't seen that session, go ahead and check it out. Really interesting stuff. But I noticed price was coming from below, and then it gapped. Take a look at this gap here. It gapped above my importance matrix key level 85.54. It gapped above that key level. It was a very important moment for me, because I noticed the gap, but I didn't know if it's going to be an exhaustion gap or a runaway gap. So I waited one more day, and when price came so strong on the downside and closed not only below that 85.54, but also below the 85.26, another key level, support key level. That moment I knew that I was looking at an exhaustion gap. Now the bigger picture that I have in place here suggests that price should go, right? My predictive system, the one that helped me to engage with this in the first place, showed me the potential on the downside, but also showed me two very important key levels to aim at. One, which was the 82.49, and the second, 82.08. And what I did was I assigned the first portions for the first target, and later portions that I got in lower for the second price target. Sometimes I do that. I play around with my price targets. I don't only have one price target. Usually I have two, sometimes even three. So I assign my portions different price targets. The higher portions that I got in, I'll give them the higher price target, right? And I'll go according to that. So this is why you can see that I have a take profit right here, but also I have a take profit right there, right? Some portions are aimed at this point and some to the next one. But anyway, price went pretty well at the beginning, so it went down the following day. I added one more portion, right? And then there was a strong move on the downside. I obviously added a third portion. But then what happened? Price reversed and began a pretty significant upside reversal, upside correction, should I say. It took 5 days. 5 days of upside correction. What did I do? So when the first day went up, right, I got out of the first portion, right? Took a nice profit, by the way. And then the second day went up, and I took the second portion out, right? In a very, very small profit, actually, that was. And then the third day went up, right? Here I did nothing, right? I had no more portions to take out, right? So I did nothing. I just waited. And then another upside day, and I did nothing again. And then another upside day, and I did nothing again. But in my mind, by the way, my stop loss level at the time was, my initial stop loss level was at 86.40. That's where it was. It was right here, somewhere here. So still very far, right? Like I said, I give it a lot of room. Usually, I from the get-go, right off the bat, I'm usually going with 200 to 250 pip stop loss level. But I said to myself, if price is going to be able to break back above 85.26 and maybe even 85.54 again, these two levels, I'm going to be out. I'm going to take out that last portion. I'm not going to even wait for the stop loss level to get hit. But it didn't happen. Usually it doesn't happen. Usually it's just a correction. So when it came back down, right, the following day, nice turnaround we had here. You can actually see you can actually see that portion still in. Take a look. This one. Still in from that portion I got left. I have left here for price to come back. And at some point it did, right? And then I added up yet again more portions on the way down. All the way down, and I'm going to continue. So if this day today, right now you're looking at real life chart. If the day going to end like it looks like right now, that's going to be nice. I'm going to add one more, and I'm going to hit 60%, and hopefully 70, and maybe even 80. I don't know. I'm not sure I'm going to be able to pass the 80% because I'm going to be very, very close to the first price target. By the way, when I'm too close to a price target, a lot of the time I get asked the question, how close? Well, it depends. If you're working with a daily chart like I do, close would be 20 pip, 10 pip, 20 pip, 30 pip would be close. 30 pip from price target, I will not add more portion. Doesn't make any sense, right? Up to 30 pip, it's too close. 40, 50 pip, I'll consider adding one more portion. But this is pretty much how I do it, right? I scale in as price goes with me. I keep increasing the position, and a lot of time I hit my price target with 80%, 90%, sometimes 100%. And just think about it, dragging the whole move, adding, subtracting in corrections. This is the most efficient way to manage your positions. One last example, like I said, right? The very recent one. Wow, it goes really well, I have to say. It goes well beyond my expectations, to be honest, for the first day. You can actually see where I entered just at the beginning of the session. I have a very solid technical picture here coming from the big weekly chart. I'm not gonna dive into this too much. This is the C-matrix methodology that I'm using, but in fact when I really got interested here was the fact that price went straight to the bottom key level 83.28 and beautifully touched base here. Take a look at this touchdown with the spike here. Price was obviously trying to break through, failing, and beginning to turn around. This was the most important moment on this technical picture. This is what drove me to establish a bullish position, right? Now, there's also this really nice head and shoulders pattern, by the way, which you probably missed because it's a bit hard to see this one. Take a look. Left shoulder, head, and little right shoulder right here, right? Right at the bottom of the move, right at my, at the bottom key level, touching base with the head here, and turning around. This is a classic. Now, so I just got in, right, at the beginning of the session. Obviously, sometimes we saw that actually on the Aussie versus the Canadian. Price can go really far from your first portion. It happens sometimes, nothing to do about it. So once this day is done, I'm probably going to add one more portion, right? It's hard to see why I'm not going to do that. I can't imagine price going back all the way down now. I mean, it can happen. Anything can happen. But most probably, I will add up one more portion unless of course, price would be too close to the 189, which is hard to imagine because that's another 150 pip. But, and we're already about 100 or 150 pip from the beginning of the session. But so if price will be too close by the end of the day to 89.04, my first key level, first resistance level, I would not add up one more portion. Right? I want to be cautious when it comes close to this level, because this may actually send it into a downside correction. Not saying, not saying it will completely turn the trend. It's just it's likely to ignite a downside correction. So I definitely want to be small when that begins, right? But once price breaks above that 89.04, I'm going to go quickly back to increasing the position again every single day. As it goes my direction, I'm going to add one more portion, all the way through to my final destination, guys. Take a look. My final destination, you can actually see my price target, my take profit order right here, right on that spot of that 95.48. That's a huge move, right? I mean, we're already 100 pip in, but we still have about 800 pip to go. That's a huge move. So here I actually plan to get there, hopefully, with 100% because there's enough distance for it. There's enough distance for me to build up 100% position size, right? Obviously, I will subtract, I will decrease the position on corrections, right? Decrease the position on corrections when it goes back up, get back to re-increase the position, hopefully reach with full force the final destination here, 95.48. All right, I think that's enough. It was pretty intense, 45 minutes. I sure hope it wasn't too overwhelming. If it was, go ahead, watch it again. Very simple. But yeah, this is pretty much the way I run my positions. This is my main money management tactic. Linear scaling, guys. Remember that. I hope you enjoyed the session, guys. I sure did. Don't forget, subscribe to the channel if you didn't already. Don't miss out on our sessions because they are priceless. I wish you a great trading day. We'll see you in the next one.